Shooting star, very similar to one of the previous candles, but in this case the body is more defined, and the shooting star you'll see at the top at a point of resistance or at a point of inflection where the market is turning. Similarly, a level of resistance in the market, there's a candle called the hanging man. You'll see that the tail in this case is inverted, where the market has pushed down, buyers have come in, pushed the market back up again, and in this case the close is below the open. In the shooting star scenario on the left, the market has pushed up, been rejected, sellers have come in, pushed the market back down, and in this case the market has closed higher than the open. On the downside, or the lower side of the market, we have what's called a hammer, pushing down, buyers come in, push the market back up to close, forming a small body. And similarly, the inverted hammer, where the market has brought in buyers, been pushed back down by sellers and closed near to the open, but forming a small body. Now, in all cases with these four examples, the actual color of the body is not really that important. Some more reversal patterns. The bullish engulfing pattern. The important point to note here is the setup candle, the first one, in this case coloured red, forms the signal candle, then forms the body of the candle, completely engulfs the preceding candle. The bearish engulfing candle at the higher levels on the market is where the market pushes up, prints the green candle, it then pushes up higher again, but the market rejects, sellers come in and push the market back down again. And again you'll see here that the open and close of the engulfing candle is above and below the open and close of the prior candle. Now, piercing pattern is where the signal candle tries to engulf the prior candle but doesn't quite succeed. However, the setup candle, in this case the red one, forms at the lower end of the market. The next candle then gaps down. The open is below the close of the previous candle. Buyers are coming in and they push up into the body of the previous candle. Now, the rule of thumb here is that if that second candle, the piercing candle, moves more than 50% into the body of the prior candle, then we have a good piercing pattern. And on the upside, where the market is rejecting at a level of resistance, this is also a piercing pattern, but in Japanese candlestick terms is called dark cloud cover. And what's happening here is the market is pushed up, forms the green candle. We then get a gap up. The market pushes, gaps up to form its open, pushes up higher. Then sellers come in, push the market back down, and it closes beyond 50% of the body of the preceding candle. The bullish harami. Now, this may look similar to the engulfing pattern, but in this case what we have is a setup candle forms, in this case the red candle, but the subsequent candle gaps up. In this case, the close of the red is below the open of the green candle. It gaps up, buyers come in and it pushes up, but stays within the body of the preceding candle. The bearish harami, on the other hand, you'll see at the higher levels of the market. Bullish candle prints, then the second candle comes in, opens, gaps down. In this case, it's showing a tail that almost pushes up to the close of the previous candle. Market then pushes down, sellers come in, and the market closes lower than its open, but within the bounds of the setup candle. Now, in this case, it doesn't really matter with the second candle whether they're a red or a green candle. Here we have a 3 candle pattern setup. This one is known as a morning star. Now, the key here with the morning star, we have a bullish 3 candle reversal pattern. The first candle will be red, bearish, then the market will gap down to the second candle body, and that candle body can be of either color. In this case we're showing it as green, and then the third candle also will have a green real body, ideally gapping up from the star candle, which is the second candle. So we have a move down, then we have a further gap down, then we have a gap up, forming the third candle. Now, you will probably only see these on daily, weekly and monthly charts. Conversely, the evening star is a bearish 3-candle reversal pattern. The first candle is bullish and has got a longer green body. The market will then gap up to the second small body. In this case, we're showing a green doji candle, and this doji candle can be either color. Then the third candle forms, and this will be a red bearish candle, and it will ideally be gapping down below the close of the evening star candle that's formed. The second candle in the 3-candle pattern can be green or red. Now lastly, with the evening star, these are more frequent on the daily, weekly and monthly chart. The last of the reversal patterns we're going to look at is what's called a tweezer top, sometimes also referred to as tram lines, where 2 candles are printed almost or exactly the same highs. In effect, what we're looking at is the market printing a high, then printing the same high again and rejecting, and then subsequently falling off. And the tweezer bottom, where we have a bullish pattern here, is showing support. The market is pushed down, rejected on the red candle and closed. Then subsequently the market has opened lower and tested the low again. Buyers have come in, and there we have a tweezer bottom. Likewise, with the tweezer top and tweezer bottom, the candles can be either color in each case. So let's have a look at a few continuation patterns. This is where a signal pattern is printed and the market continues in the direction to which it was trading. Here we have what's called an up gap Tsuki. Now the up gap Tsuki is a 2-candle pattern. The uptrend gaps up to a green candle. It is then followed by a rejection with a red candle, and that red candle opening inside the body of the prior candle, and it closes below the real body of the green. The market then subsequently gaps up and continues in an upward direction. Here we have a down gap Tsuki. Now again, the down gap Tsuki is a bearish 2-candle continuation pattern. The downtrend in this case gaps down to a red candle, followed by the green candle, which is pushing the market back up again. And the points to note here is that the green candle opens inside and closes above the red candle's real body. The last of the 2 continuation patterns we're going to look at is what's called the falling 3. Here we have the market is trending downwards. We print a long bearish candle, which is then followed by 3 smaller candles pushing the market back up. Now those 3 candles I've shown as green there, but as long as they are showing a reversal, they can be of either color. After those 3 candles are printed, the market then rejects that recovery and the bears come back in and push the market down. Conversely, we have the rising 3, where the market is in an uptrend. A green candle is printed where the bulls are buying into the market, pushing it up. Then the sellers come in, try to push the market back down. And again here, all 3 candles are contained within that initial bullish candle. After that 3rd candle is printed, the bulls then come back in with a more concerted push. This time, the close of the bullish candle is above the close of the initial bullish candle, and the market continues in its uptrend. So let's have a look at some charts. Here you can see an example of a morning star. Here's a bearish harami. Incidentally, that bearish harami printed at all-time highs. So to look left on your chart, there was no support or resistance. So the only clue that you are getting that there's a potential reversal at this all-time high was the formation of that daily candle pattern. You can see after that harami, the market dropped, then the market then sold off very heavily. Here we have a bearish engulfing, and here you see a good example of an evening star. Look at one more chart, the DAX. There we have a tweezer top. You'll note here that the bodies are slightly different lengths. The key here is we've printed a high more or less at the same level. So the market's pushed up, closed on its high of the day, the next day it's opened, pushed back down again. Another example of a tweezer top on the far right. There we have a bearish harami. Here we have a good example of a pin bar. So, in summary, the candlestick chart give the trader clues to a market's sentiment, i.e. are buyers or sellers driving the market. Momentum, how strongly the market is moving in any particular direction. They also help to confirm support and resistance levels. This can be points of inflection, i.e. a point where the market turns. or a turning point in the market, not necessarily at a strong support and resistance level, but maybe the start of a new level of support and resistance, or confirming prior points of inflection into new levels of support and resistance. A candlestick is only valid when it's completely formed. Candlestick patterns can be learned, and they can assist the trader when entering and exiting a trade. Candlestick patterns are most effective when used in conjunction with chart analysis and price action. They're just part of our armory when we're looking and analysing a market. They're used in conjunction with price action and other technical analysis.